In part one of this webinar, you learned that companies are treated by the law as legal or juristic persons. They are responsible for their own debts and they're responsible for their own management. And this fact made it possible for them to raise the large sums of capital that they needed to undertake huge projects, which became possible as a result of the technologies that developed during the Industrial Revolution. The Companies Act is a body of law which grew up to cater for these new types of organizations. And key to that is the concept of disclosure. Companies have to disclose certain pieces of information to their shareholders in order to enable them to make good investment decisions. Remember, the shareholders are not involved in the company's management and so therefore would not know these things unless they were disclosed. Among the things that the company has to disclose is the prospectus whenever selling shares to the public, and that of course contains details of the subscribers to the memorandum, the objectives of the company as well as a forecast of their future profits. And also of course the company's financial statements must be disclosed to the public twice a year, interim and final. You also learned that listed companies listed on the stock exchange have to comply with the JSE rules, and those require a lot more disclosure through the Stock Exchange News Service, or SENS as it is known. All sorts of information has to be disclosed on the SENS. In this webinar, we're going to go further and look at some of the other things contained in the Companies Act. The Companies Act requires that all companies must have a Memorandum of Incorporation. This document specifies the internal relationship within the company and then the external relationship with outsiders. In addition, the Companies Act requires that all companies must have an annual general meeting at which the voting shareholders can vote their shares. That's usually the ordinary shareholders. At those meetings, they vote on various different resolutions. There are two types of resolution, an ordinary resolution and a special resolution. An ordinary resolution only requires 50% or a majority of the shareholders to approve. And that would be a resolution which would be, for example, appointing new directors or perhaps expanding the company's share capital, those kind of things. A special resolution is a far more serious matter, and that requires at least a 75% majority to approve. And that would be for a thing like a merger, a takeover, a major acquisition, or a change in the nature of the business, usually some sort of event which is going to see a change in the control of the company. In terms of the Companies Act, you must have at least 50% for an ordinary resolution and 75% for a special resolution. However, you can, in the Memorandum of Incorporation, specify a higher than 50% requirement for an ordinary resolution. And special resolutions can also be more than 75%. The only rule is that a special resolution must have more than 10% above an ordinary resolution. That's the only rule. The Companies Act calls the sort of decisions or resolutions which require a special resolution, it calls them fundamental transactions. And as I said earlier, they usually involve a change of control of the business. As we have seen, companies must produce financial statements twice a year, the interim and the final. And those financial statements must include the balance sheet, the income statement, the cash flow statement, statement of changes in equity, a director's report, and an auditor's report. Listed companies will always have to be audited because of their size. The Companies Act determines the size of a company by applying what is known as the public interest test. In terms of this test, a company scores 1 point for every employee that it has, 1 point for every R1 million of unsecured debt that it has, and 1 point for every R1,000,000 of turnover that it has, and 1 point for every shareholder. So if you add up those points, you get its public interest score. If the company's financial statements are prepared by one of its own employees, and it has scored more than 300 points in the test, then it will require an external audit by a properly qualified chartered accountant. On the other hand, if it has less than 300 points, it would mean that it only needs an independent review, which would of course be much cheaper. On the other hand, if its financial statements were prepared by an independent external accounting professional, then a full audit would only be required if it scored more than 750 points in the public interest test. Clearly, private companies, which cannot have more than 50 shareholders, for example, will always be allowed the cheaper independent review, while most public companies, and especially those listed on the JSE, will need to have a full audit. The shareholders of a company have contributed capital to the growth and building of that company. Their objective is to obtain dividends in due course. Obviously, they do not want that capital base which they have contributed to be eroded in any way. And for this reason, early Companies Acts used to insist on what they called a capital preservation doctrine. And this doctrine had a number of requirements, but perhaps the most important was that dividends could not be paid out of the asset base of the company. They had to be paid out of profits. And this gave rise to the distinction between distributable reserves, which could be distributed in the form of dividends, and non-distributable reserves, which could not. More recently, the Companies Acts have changed to embrace what is known as a solvency and liquidity principle, rather than the capital preservation principle. In terms of this principle, companies must pass what is called a solvency and liquidity test. And they have to pass this test before they can pay out any dividends, before they can lend money to their directors, before they can buy their own shares back, and before they can conduct a statutory merger. To pass a solvency and liquidity test, the directors must ensure that the company is first of all solvent. In other words, it has more assets than its liabilities. And secondly, they must ensure that the company is liquid. And this means that it must have sufficient funds to pay all its expected expenses over the next 12 months. One of the key decisions that must be taken at the annual general meeting of a company is the appointment of its directors. The Companies Act is very particular about directors and their responsibilities and obligations. They are bound by a rule called umberrimi fide, which means in Latin the utmost good faith. They must do what is in the best interests of the company and the shareholders at all times. The directors of a large listed company also have to abide by what are known as the King Report's corporate governance rules. And these require that they act in a sustainable way, which means they must look after the environment, they must look after the community within which the company operates, and they must look after their employees. If the company scores more than 500 on that public interest test that we spoke about before, then it also has to have a social and ethics committee. And this committee is there to ensure that the company abides by certain key rules. It must abide by the United Nations Global Compact principles, by the OECD recommendations on corruption, by the Employment Equity Act, and by the broadly based Black Economic Empowerment Act. This committee also ensures that the company is doing what is best for the community, its employees, the environment, its health and public safety record, and also its relationship with the consumer. All of those things. So you can see that the directors of a big listed company have got a lot of responsibilities and obligations. Companies can have non-executive directors and also alternate directors, as well as executive directors. But the Companies Act does not distinguish between executive and non-executive directors. An executive director is simply a director who is employed full-time by the company, while a non-executive director only comes to board meetings. But they all have the same responsibilities and obligations. You can see that the directors of a company carry a great load of responsibility for the proper running of the company. They can be held personally liable for their conduct as directors, especially in terms of the new Companies Act and with the advent of the King III report on corporate governance. Because of this, there was a danger that directors might not be willing to take the kind of risks that they need to take to create a successful business. So the new Companies Act provides for them a defense which they can invoke for risk-taking, and that's called the business judgment rule. Essentially, this says that the director cannot be held liable for his decisions provided he made the decision in good faith, exercised care, skill and diligence, and complied with his fiduciary duties. To take advantage of this defense, he must have taken steps to find out about the matter in detail, and he must have no personal financial interest in the decision. And he must also believe that the decision is made in the best interests of the company. If all those things are in place, then he can take advantage of the business judgment rule. Not all companies succeed in business, and the Companies Act has an entire section devoted to the handling of companies which find themselves in a distressed situation. In such a situation, the directors of the company, its creditors, or other interested parties can apply for a company to be placed under business rescue. The idea of business rescue is to try and save companies from being liquidated before it is too late. As soon as they are placed under business rescue, a business rescue practitioner is appointed, and his job is to turn the company around so that it is once again both profitable and solvent. The benefit of business rescue is that it prevents the creditors of the company from applying for its liquidation. In effect, it gives a period of relief from the need to pay creditors, while the business rescue practitioner tries to get it back on its feet. However, before a company can be put under business rescue, it must convince the court that there is a reasonable prospect that it can be saved. Typically, a company which is profitable but has no cash would be a good example of a company that needs business rescue. In this situation, it can arise when a company has got lots of stock and debtors but no cash on hand. It's profitable, but it's illiquid. Then it would be a good case for business rescue. In these two webinars, we have only just touched the surface of company law. Their aim has been to give you a good working knowledge of the basics and at the same time to familiarize you with the language of company law. The Companies Act number 71 of 2008 has 225 sections which are arranged in 9 chapters. In addition to this, it has regulations which consist of 8 chapters and 179 sections. Together with GAAP and other international regulations, they cover every aspect of companies in great detail. There is also a growing body of case law, where various aspects of the Act have been tested in court. So you can see that company law is an enormous subject. But as an investor, you only need to know the main aspects and those parts of the Companies Act which will impact on you as an investor.